Okay, good morning, everyone. Today's Thursday, November 5th, and I'm going to finish, if I don't trip, I'm going to finish discussion of Chapter 4 today, and we may start in on 5, although we may not get there. I have to apologize, we don't have your midterms done yet. One of our team members got sick. They'll be finished on Tuesday for sure. I'm sorry about that. Okay, so Chapter 4 is about financial futures, and we've talked about interest rates. I want to talk about the intersection of interest rates and exchange rates. There's a very large global market in foreign exchange. This money moves around seeking the highest rate of return. And there's a popular trade in the currency market called the carry trade. Carry trade. And because of the carry trade, there's a certain amount of arbitrage in these markets and a convergence to what we call interest rate parity. And what does that mean? Well, if we think about a carry trade, a popular trade would be to borrow money in a country with a low interest rate. Let's say we borrow money in Japan or the United States that has a low interest rate, and then we convert the Japanese yen or the US dollars into some foreign currency, let's say Australian dollars or Brazilian real, and we invest in the foreign country at a higher rate of interest. And after some time, we move the money back into the original currency, the Japanese yen or the US dollar, to repay our loan. Okay, so we borrow at a low rate of interest, and we invest at a high rate of interest. If the interest rate in Japan is 0.25%, and the interest rate in Australia is 5%, then you can earn a higher rate of return. However, the problem you face is when you move the money back, the exchange rate might be different from the rate when you initially invested in Australia. So there's a relationship between these interest rates and spot and forward, and you can think of the forward rates or rates on the futures market for currencies. So that's what interest rate parity is all about. And I'll give you an example of this. So the interest rate parity, it's a mathematical relationship, and it says the difference between the risk-free interest rate. So let's say you're investing in government treasuries in Australia. So that's kind of a risk-free rate. The difference between risk-free interest rates paid on two currencies should equal the difference between the spot and forward rate. That's the relationship. And I'll give you an example of it in one or two slides. So if this is violated, then there's an arbitrage opportunity. If interest rate parity doesn't hold, then there's an arbitrage opportunity. The simplest example we can think of is, let's suppose the spot rate and the forward rate, and you know what I mean by forward rate. Spot rate is a rate today that you can convert one currency to another. And the forward rate, or the futures rate, is the rate available to you down the road. So today you might agree that you're going to buy Japanese yen with Australian dollars in 3 months' time, and the bank will give you that exchange rate today, and we know what the spot rate is. So let's suppose that those rates are the same. Let's suppose that, just for simplicity, the exchange rate is 100 yen per 1 Australian dollar. That's the spot rate. and it's also the forward rate. So you could convert the money back at the same exchange rate. If that's the case, and the interest rate was 1/4% in Australia and 5%, did I say Australia? 1/4% in Japan and 5% in Australia, you'd see a lot of money moving from Japan to Australia, right? And that would possibly move the currency. So there's an arbitrage opportunity. Now, usually there's a difference between the spot and the forward rate. So these bullet points here basically go through what I've just explained to you as to what a carry trade is. Does anybody have a question on the definition of a carry trade or this interest rate parity? Okay, we're going to look at an example just after I show you these interest rates. So actually, the carry trade is sort of coming back. The volume of foreign currency that's chasing these higher interest rates will change over time, depending on interest rate spreads. But here's a chart showing the rate on government 10-year notes. And you see in Argentina, the interest rate is close to 25%. In Brazil and Venezuela, it's around 15%. So these are current rates. I think in Brazil it's even gone up to 16%. So you could take your money from here, move it down to Brazil. You have to convert it into Brazilian real, and you earn 16% interest, which seems like a good deal. But then you have to be concerned about what exchange rate you're going to bring it back at. Russia, the interest rate is 10%. And you see in Japan, it's almost zero. So if you have money in one of these countries, Japan, Canada, or the United States, you might be very interested in investing in a country that has a high interest rate. Yeah.
Does those countries with high interest rates have like a very high chance of default?
The question is, those countries with high interest rates, is there a chance of default? I would have to say yes. In a case of, let's say, Argentina, Venezuela, or Brazil, there is some risk of default. So it's not exactly a risk-free rate.
I learned from the other class, like U.S. federal treasury, like the default chance, like almost like zero, right?
Right. Right.
For the other.
Yeah, there's certainly some risk of default, especially in some of these transition economies. And that's obviously a factor, but oftentimes, these carry trades are conducted over a relatively short period of time, maybe a 3-month period or something like that, because they want to lock in that forward rate as well. So let's look at an example, okay? So here's an example of interest rate parity. So you'll see on some old exams, once in a while I'll ask a question. I'll give you the information and then ask you whether to work out the interest rate parity and to determine whether it holds or not. So up on top, we have our assumptions, our data. And let's say there's a 3-month rate on the US LIBOR. What's that? So it's US dollars invested in, let's say, London. And that rate is 0.41%. It's a short-term rate. And a 3-month interest rate on the Australian LIBOR, so that would be Australian dollars, let's say in the London Bank, or we could use rates from the Bank of Australia as well. But maybe if you're concerned about default, you might, you can invest also in a foreign currency and put your money not in the home country, but in a different country. So there's a big difference in the rates, right? 4.85% versus 0.41%. So it might be attractive to borrow US dollars and pay the 0.41 and invest in the Australian dollars and recoup the 4.85. So the question we ask ourselves, because we're concerned about whether or not this is an arbitrage opportunity, should I buy Australian dollars and invest those at the high interest rate? And let's assume that we have a $1 million investment. The current exchange rate, the spot rate, is 1.04 Australian dollars to the US dollar. That's the current exchange rate. And here we have the forward rate. The forward rate is 1.03. So in 3 months' time, the exchange rate, it'll cost you fewer dollars to get 1 Australian dollar than today. Okay. So let's work towards an interest rate parity, which basically compares the two rates of interest adjusted for any difference in the exchange rate. So first of all, when we write down 0.4% or 4.85%, those are annualized rates, and therefore we have to calculate the effective 3-month rate. So we want to divide those each by 4 because we're looking at a 3-month investment, which is 1 quarter. So we divide those rates by 4, and this gives us the rate over a 3-month period for US dollars, and this is the rate over a 3-month period for Australian dollars. Okay. So clearly the US rate is less than the Australian rate. If the spot and the forward rate were equal, so we could buy Australian dollars today at 1.04 and lock in a forward rate at 1.04, then 1.04 minus 1.04 is 0, so this would cancel out. So it's a very simple calculation if, in fact, the spot and forward rates are the same, but they're not the same. So we have to adjust that higher rate of interest. So if we look at our total investment, we have $1 million, okay? After a 3-month time period, if we leave our money in US dollars, we're going to earn just over $1,000 US, okay? 1,025 at that low rate of interest right here. So that would be the outcome if we didn't change the money. If we changed it to Australian dollars, then we get $961,000 times this higher rate of interest. And then we convert that at the forward rate. That gives us back a profit of $2,393. Okay? So clearly, you're better off buying the Australian dollars because you're going to make $2,300 versus $1,000 if you leave it in the US. So the interest rate parity does not hold. And if we write down the equation here where we adjust the higher rate of interest by the difference between the spot and the forward rate, this is going to be a negative number, isn't it? 1.03 minus 1.04 divided by 1.04, that's close to 1, about 0.96, I think. We subtract that from 1.21, and we see that even the adjusted rate is higher. So we're adjusting that high interest rate for the difference between the spot and forward, and we see it's 0.251. So yes, you would move your money into the Australian currency, and the interest rate parity does not hold. Let's just go back up here and say, well, suppose the forward rate was 1.02. instead of 1.03. Then if it was 1.02 and you put your money in Australian dollars, and at the spot rate and convert it back at the forward rate of 1.02, then you're losing some money on this difference in the exchange rate, and you only end up with 992,000. So there you have a situation where we just changed the exchange rate slightly. It doesn't take much of a change, right? We're going from 1.03 to 1.02, and then it makes no sense to invest in the Australian dollar, even though the interest rate is higher in Australia. Okay. Questions on this example? Okay. Come back to bonds for a minute. This was the Wall Street Journal yesterday. We look at the price of December 15 bonds, and it's 154 and 28 seconds. The price of March is 153 17 seconds. In Chapter 3, we talked about intertemporal price spreads for commodities such as sugar or corn. And we talked about contango, which is a normal relationship where the distant future is above the nearby. When we look at bonds, this is a typical relationship where the price down the road, this is 3 months down the road, is actually less than the current price. But that doesn't mean the cost of carry model doesn't apply here. When we talk about sugar or corn, remember, we talked about the spot price plus full cost of carry, full storage costs. And we might expect that the futures price is equal to the spot price plus full carry. Well, in fact, in the bond market, that's exactly what we're looking at here, except in the bond market, we have a negative cost of carry because bonds pay a coupon rate. So if you purchased bonds in the cash market and sold the futures and then delivered those bonds in 3 months' time, while you're holding the bond, it's going to pay you some revenue, and that you offset against the interest costs from initially buying it. Whereas if you buy corn or you buy heating oil, you pay the spot price and you put it into a storage facility. It's not paying you any revenue, is it? So the cost of carry there, if we ignore convenience yield for the time being, is going to be positive. Okay? So this foundation that we discussed with those commodities such as corn and sugar also applies to the financial futures. Okay? And that's the cost of carry model, where the futures price is equal to the spot price. The futures price is equal to the spot price plus the net cost of carry. Okay? And the thing with bonds is there's going to be a coupon payment, and if the coupon interest is less than the funding cost, so what's the funding cost? Well, if you look at that December-March bond market, you might think of buying December, taking delivery. Remember, bonds is a deliverable contract. Taking delivery, so you have to pay for the bond in December. And you have to borrow money to do that, so that's the funding cost. You hold the bond till March and re-deliver on the futures contract. You collect the coupon interest, so you compare the funding cost to the coupon interest. If the coupon interest is less than the funding cost, then it's a negative carry. If it's greater, then it's a positive carry. Okay? So the implication is that futures prices will be less than cash prices in the bond market. So when we're comparing March and December, March is less than the December price. So if we go to our cost of carry model, this is something we looked at in Chapter 3. Here's the futures price, right? This is the spot price, and this is a cost of carry. Cost of carry. So this can apply to any market, not just the bond market. Let's say if we're looking at soybeans, for example, and the futures price is $11, that might equal the spot price, which is $10, times the cost of carry. Let's say it's 10%. Okay? So that would be the result in the soybean market, where 10% cost to carry, let's say for a 12-month time spread, let's say December 15 to December 16, then the December price would be 10, December 15 would be 10, December 16 would be 11, and the difference is a cost to carry. Okay. And that's just what we've written down here. Now, looking at the bond market, here's a different set of prices. June is at 97.30, SEP is at 96.29. Same relationship. SEP is below June. Okay, SEP is below June, and that's not unusual in the bond market. And I'm going to carry those prices over to our cost of carry model. So the net cost of carrying the bond from June to September, so that's a 3-month time period. As we just said a few minutes ago, it has two components, the financing cost and the interest paid on the bond. The financing costs arises from the fact that if you buy December, or in this case you're buying June, September, sorry. You're buying June, so we're going to buy June, we're going to take delivery, and at the same time you're going to sell September, then you're going to deliver. So you have to borrow money to buy the June, or even if you have the money, you have to account for the opportunity cost of those funds. So even if you have the money in the bank, there is some carry costs. And let's suppose a carry cost is 2.5%. Okay? And the bond pays you $1,500 per quarter, because the T-bond futures are based on a 6% interest rate on $100,000, right? So that would be $1,500. So we compare the financing costs. So we're borrowing money at 2.5%. Divide that by 4 because it's an annualized rate. We only need the money for 3 months. And then you compare that to the coupon rate, which is $1,500, and you'll see that the cost of carry is minus 888. Actually, you get money back because the coupon payment exceeds your financing costs. So then we write down the arbitrage condition, and these are just the prices of the June and the September, right? We said June was, what price did I have on June? We said June was 97.30, right? 97.30 on the June, and SEP is 96.29, 96.29 on the SEP. Okay, and if we subtract the negative cost to carry, the return, 888, from the June price, you see we almost get the September price. So, the equation I wrote down for soybeans were the cost carry model held exactly, right? It costs $1 to carry the soybeans for 12 months. So the difference between D15 and D16 was exactly $1. We see here that the difference is very close to $888. 96906 is very close to 97049. So it approximately holds. Arbitrage is at work. And it's obviously very easy to arbitrage a market like the bond market. So if the coupon rate greatly exceeded the cost of financing, well, clearly, entrepreneurs are going to buy the nearby, sell the distant, hold the bond, and earn a rate of return. The arbitrage opportunity is going to drive those prices back into line, adhering to the cost of carry. And we saw in our example that it was approximately equal to the cost of carry. Sky, yeah.
Yeah, just have a few questions about the terms.
Yeah.
The funding cost is also the cost of financing, right?
Funding cost is a cost of financing, yes.
And it's related to the discount rate. Like the cost of financing rate is also the discount rate.
Well, I wouldn't say they're the same, no. Discount rate means something different. Okay.
So here if we want to get the funding cost, we directly times the cost of finance rate with the spot price.
Yeah, you're buying the nearby, so in that example, you're buying June. So when June comes, you receive delivery. So you take the treasury bond in June, and you have to pay the clearinghouse for the bond. Okay. And then you hold the bond until September, so that's the cost of financing it, and then you deliver.
Okay, and also the returns is the accrued interest, right?
Pardon me?
I mean, the return here means accrued interest.
A coupon rate.
Just a
Coupon rate, yeah. So it's 6% on 100,000 over 1 year, or $1,500 for 1 quarter.
and carry charges on top.
Yeah, the carry charge is a 2.5%. Okay.
And the carry charges is the same as funding cost.
Yeah, with bonds, it's just electronic. It's not like sugar or heating oil where you need a facility to store them. So, yeah. Okay. Whereas with sugar, you have both the financing costs and the physical costs, right? Here, there's no real physical cost, right? So when we write down, these cost of carry equations, whether we're writing it down for corn or soybeans or treasury bonds, there's also one more term. This will be the last term in Chapter 4 that I'll talk about, and it's called the repo rate, which is shorthand for the implied repurchase rate. It's the implied repo rate. And if we rewrite that cost of carry model, right? So the cost of carry model was the futures price is equal to the spot price plus the carry costs. If we solve that equation for the cost of carry, that's equal to the ratio of the futures price over the spot price. So if we went back to our soybean example, then that would be $11 over $10 minus 1, right? Or is equal to 0.1. So that's our repo rate, which is another way to define the implied cost of carry, the repurchase rate. Okay? So it's the implied difference between the futures and spot price. And once again, it doesn't matter if we're talking about corn, soybeans, or treasury bonds. Okay? All right. So we've nailed Chapter 4. Now I'm going to go on to Chapter 5 and 6. So you should be reading, by next week, a week from today, you should read through Chapter 7. Okay? Chapter 5 and 6 I go through fairly quickly. Then we spend a little more time on 7 and 8. But clearly by the midterm, which is in a couple of weeks, I think, and we have a quiz before that, we're going to be well into Chapter 7 and probably Chapter 8. So it'd be a good idea to read ahead just to give you some indication of where we're at. Okay, so Chapter 5 is about forecasting futures prices, and it's something you're doing in your stock track game. and 5 talks about fundamental analysis, and 6 talks about technical analysis. So I told you on day 1 that this course, I'm not like Ken Roberts where I'm going to stand up here and tell you that I know how you can all become millionaires trading the futures market. If I did that, I'd be doing a big disservice because I'd be telling you a big lie. It's not easy to make money in the futures market as a speculator for the simple reason that these markets are informationally efficient. Okay? They're informationally efficient. But there are 2 approaches that traders use. There's still a lot of interest on the speculative side because of the leverage and the high potential return. Okay? There are 2 approaches to trading. And the Ken Roberts of the world, a lot of managed money will follow what we call technical analysis. And the reason they do that is it's pretty easy. All you need is a computer, and it studies the market itself and pretty much ignores supply and demand. So if you buy the Ken Roberts book and the Ken Roberts tape, he's going to have a method for trading that uses past prices to predict future prices. It uses a history to tell you where we're going, and that's called technical analysis. It's not something that that most economists would support because these markets are informationally efficient. And what's past is past. And most economists would say you cannot use past prices to predict future prices. The other approach is fundamental analysis. And I hope you're doing some of that in StockTrack. A fundamental trader will become an expert on a certain market, whether it's the sugar market or the corn market or the gold market, and they study supply and demand factors. So if you're studying sugar, we see the price of sugar has risen, partly due to weather considerations, partly due to demand. The price got so low that demand for sugar increased. So you look at supply and demand factors, you look at inventories, you look at cropping patterns around the world, and then you try to come up with an intrinsic value. So given what we know about supply and demand, what should the price of sugar be? Given what we know about supply and demand, crude oil is now $45, something like that. What should the price of crude oil be? And if you think it should be $70, and some experts believe that, then obviously you would go long in the futures market. Whereas if you're a technical trader, you wouldn't be too concerned about supply and demand factors. So when I say that the market is informationally efficient, what does that mean? It means when there's information, there's news on fundamental factors. There's news on the weather. There's news on number of oil rigs that are being removed. There's news on war conditions in the Middle East or what's happening in Venezuela. That's all information. And if the market's informationally efficient, it means that it incorporates that information. That's what it means. It incorporates that information. And so we have this basket of information today. Tomorrow, there's going to be some additional information that could be different. And the market will quickly respond to that. Think of the orange juice futures example I gave you early on in the quarter, where we found that the futures market actually does a better job of incorporating expectations of the weather than the National Weather Service does. So even if you were the world's best weather forecaster, you still might have a hard time making money in that orange juice market, informationally efficient. And how does that then translate into price behavior? Well, you know that prices fluctuate. We've all looked at graphs of futures prices. Prices fluctuate all over the place. And we call that sort of the stochastic price behavior. And the simplest way we can describe that behavior for futures markets is to say that most futures markets follow a random walk. Most futures prices follow a random walk. Do not forget that. Okay? What's a random walk? When I was in college many years ago, we had a roommate. I lived with a group of guys, and his nickname was Random Walk. Right? Now, why do you suppose we gave him that name? Any idea? He was unpredictable, right? We couldn't predict his behavior today based on past behavior. So we called him Random Walk, and it was very fitting for this individual. Okay? So that's just like the price of orange juice or the price of sugar. It's unpredictable. I'm sorry, it's unpredictable. So that implies that price changes from day to day average to zero if you have a random walk. Some days the news is going to be bullish and the price is going to go up. And the fact that it went up yesterday is kind of irrelevant with regard to the news today. The news today could push it down, it could push it up. You know, it's a random walk. And some of the statistics books, when they talk about a random walk, they're talking about a guy who was walking home from the bar after having too many beers, and you know where the bar is located, you know where his apartment is located. But given that he's standing on the corner of 3rd and G, and his apartment is on 5th and G, given that you know where he's standing, it doesn't necessarily mean he's going to go towards his apartment, right? He could go the other way, he could go west, he could go east. His path home, if he ever gets there, he might the next day, is a random walk, okay? Price changes are random, so you can't predict the future from the past. Why are price changes random? Because information as to whether it's bullish or bearish, as whether it's positive or negative, is random. So when we write down the random walk equation, it's just this simple equation. The price at time t, that's today, closing price, is equal to the price t minus 1. That's the closing price yesterday, which was Wednesday, plus a residual, an error term, E sub t. E is an error term. If we move the pt minus 1 to the left-hand side, then we have an expression for the expected price change. The expected price change between Wednesday and Thursday is going to equal the expected error term, which is 0. So on average, we expect price changes to be 0. Some days are positive, some days they're negative. So here's a graph that you should all recognize, right? If I put this graph on the midterm and ask you what it is, you should automatically know that that's the price of WTI. Right? It hit 140 back in 2008. Then what happened in 2008? We talked about it last time. 2 words. 2008, there was a financial crisis. Boom, the price came from 140 down to 35. I remember watching a very wealthy oil man on TV, and I'm going to talk about him probably next week, T. Boone Pickens, in 2008, and he was on CNBC, and so the guy's a billionaire, so, you think what he's talking about. And he said oil's going to $200 a barrel and maybe $300 a barrel, okay? He's been in the news lately, too. And he now claims it's going to be $70 before a year's out. But this, my friends, is a picture of a random walk. Okay? How do we know that? Well, another way of describing it statistically is that it's not mean reverting. Okay? So if we drew a chart that looked like this, okay, then I would say that that's stationary, or it's mean reverting. Unlike this guy, that's non-stationary, okay, or it's non-mean reverting. So can anybody tell me what this chart might depict? It's mean reverting. That could be the average daily temperature in Honolulu, okay, over a 6-month period. Yeah, it fluctuates, but it never goes to 120 degrees. It never goes to 20 degrees. It never freezes in Honolulu. So you don't get these kinds of gyrations. So if the price is here, you could probably predict that in the next few days it's going to be up here, right? It's probably going to be higher. It's reverting back to the mean. So it's much easier to predict the average temperature in Honolulu in October than it is to predict the price of WTI in October, right? Because we don't know where it's going. Here it sits. T. Boone says it's going back here. We don't know. Could go down here. So this is a typical random walk. The fact that it started rising here didn't imply that it was going to be mean reverting. It wasn't going to go back to this level. No, it went to a new level. And then it came crashing down, and now we have this pattern. So I could put up almost any chart for a futures contract, and the picture would look like this. This is a very important concept that I've just been talking about in the last 10 minutes. And we're going to actually come back to it the very last day of class. Because this is how prices behave in the futures market. They behave this way because the information is random and the prices can take off in a certain direction for a certain period of time. And just because the price is here, just because the price is at $140 in 2008, okay, and we think this guy's apartment is over here. T. Boone thought his apartment was at 300, so he said, he's going to go that direction. Well, no, he was wrong. Now, if you were a chartist, you'd have all your charts going this way, right? And they're all pointing north. And you would have been long, big time, at 140. And then the market came crashing down. Just because the price is at this point does not mean we can predict where it's going to be the next week, whether it's higher or lower. That's the theory of random walk. Hey, Janet, maybe we can get set up. So we're going to show you a video clip from CNBC. Anybody ever watch the show Futures Now on CNBC? Oh, I just gave you a good trading tip. I said I wouldn't, and I did. Yeah. Oh, Max. That's Maxime's.
Each day, our planet awakens with signs of opportunity. But with opportunity comes risk. And to manage this risk, the world turns to CME Group. We help farmers lock in future prices. Banks manage interest rate changes. And airlines hedge fuel costs. All so they can manage their risks and move forward. It's simply a matter of following the signs. They all lead here. CME Group, how the world advances.
Live from the NYMEX, this is Futures Now. Welcome to the program. I'm Jackie DeAngelis. Lots to get to today. Commodities making historic moves. We're going to give you a gold trade. Also,